Good morning, everyone watching live on BAM YouTube. You can find this YouTube channel by searching @NowBAM. Let me know in the comments where you are tuning in live from today. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period for every single real estate professional, be it an agent, a broker, a team leader, an attorney, a lender, an appraiser. So share this episode with anybody in your ecosystem. On today's hot sheet, I will cover Goldman Sachs Market Outlook. Have mortgage rates reached their peak? A very reputable source indicates that it might have. IRS Funding, what that means for you, and the gas stove controversy. Today is Friday, January the 13th, 2023, and the hot sheet starts now. Good morning. This is day 5 of the hot sheet. Really, really excited. We made it all the way through the week. We're committed to doing the show every single day, all year long in 2023, Monday through Friday, 9:30 a.m. Eastern. Hit the thumbs up if you've been with me all week. Hit the thumbs up if it's your first time. Just hit the thumbs up, please. It helps more people become aware of this show. Consider sharing it to somebody within your team, within your office, or just within your network, whether it's your home inspector, your lender, your attorney, your appraiser. Share this show, please, with someone who could benefit from the information. It's your 24-hour look back on the housing market as it relates to every real estate professional. And this week, we've had a whole bunch of good news, right? Thankfully, we've had a whole bunch of good news. We talked about it yesterday on yesterday's show with the CPI data. You can go check that up. They're still under the live tab here on the YouTube channel. If you want to go look at any of this week's hot sheets, they'll always live under that live tab, and they're on Spotify and Apple, wherever you listen to pods as well. But the news has been great. It's reflected 30-year mortgage interest rates, which we've seen all week come down. Today could potentially be a day where we're in the 5s on average nationally for mortgage rates. We're going to talk about that in just a little bit. But despite all the good news, not everybody is as bullish. Goldman Sachs has their predictions, their outlook on the market, not only this year, but moving forward the next couple years. Let's dive in and see what Goldman Sachs says about the housing market. Lance Lambert, who I've talked about before, Lance is with Fortune magazine. He's a great Twitter follow. Says that Goldman Sachs says the following housing markets will see home prices fall by more than 10% in 2023. So despite all the good news, Goldman Sachs is predicting Austin, San Francisco, San Diego, Phoenix, Denver, Seattle, Tampa, Las Vegas, Portland, and Dallas will see a more than 10% drop in home prices, in home values in 2023. If you're in one of those markets, in the live chat on YouTube, let me know. Do you agree? Do you disagree? What are you seeing right now that would indicate either way, whether you agree, disagree in one of those major cities, one of those major metro areas? By the way, live chat on YouTube. You can always see the live chat when this video is done live streaming. You can also leave a comment there if you're watching it after the fact. Okay, so San Francisco, Austin, San Diego, Phoenix, Denver, Seattle, Tampa, Las Vegas, Portland, and Dallas, all expected by Goldman Sachs to see this 10% or more drop. They do anticipate that Miami, if you're seeing this on YouTube right now, hit the thumbs up. Miami will be one of the markets that actually appreciates. Okay, so they're looking at these large metro area, these cities in 2023. And you can see, if you're looking on YouTube, there's a whole bunch of them. Austin, all the way, I would say going all the way to Detroit here. You got LA in there, Washington, D.C., Houston, Charlotte, Atlanta, Boston, Dallas, Portland, Vegas, and the other cities that we mentioned, where they are forecasting significant declines in home values. They only have Miami as a major city and Baltimore, Maryland going up in value. Obviously, Baltimore, Maryland, you could anticipate, the D.C. connection there. Probably people finding more value in Baltimore than right in DC. So maybe that's where their projection comes in for Baltimore going up in value, because let's face it, Goldman Sachs is not very bullish on real estate home values as it relates to 2023. They see a slight decline for Philadelphia, a very slight decline, New York and St. Louis as well. I will say I agree with the New York one. New York got beat up so much while the rest of the country during COVID was accelerating. Like New York City didn't have that pop like the rest of the country. As people go back to work, as people go back into the cities, I could see New York City actually appreciating. I know Goldman Sachs doesn't see that, but I could see the city appreciating in 2023. If you're in the city or you're close to the city, if you're in the metro area there, let me know in the comments what you feel about New York City or any of these cities in particular, especially if you work in one of those cities that Goldman Sachs is saying is going to see a 10% or more decline. Also, Goldman Sachs downgrading the housing market not only says 2023, they believe that these values are going to fall, but they believe that in 2024, overall, they will fall 2.2%. They're calling for an overall 7.5% decline in prices in 2023. So this is measured by Case-Shiller. They're calling Goldman Sachs and Case-Shiller saying negative 7.5% home values for 2023 and another negative 2.2% in 2024. Then they believe not until 2025 that national home prices will begin to rebound, and they're projecting a positive 3.8% in 2025. Let's look at the entire chart here for Goldman Sachs. And this chart, by the way, I believe I've tweeted this out. You can follow me at Byron Lazine on Twitter. This chart is Goldman Sachs U.S. Economic and Financial Outlook. Okay, so they're going all the way out to 2025 on this. If you're seeing this, obviously, on YouTube or on Spotify after the fact, you can see the housing market, the housing market section here. Apologize for that extra line right there. And they're going to go through housing starts, units in thousands, new home sales, units in thousands, existing home sales, and then the Case-Shiller home prices that you can see here on this report, on this table. Okay. Let's just take a look what they're projecting for new home sales. Okay. 2023 new home sales, 549,000, 625,000 was the 2022 number. Existing home sales, they're talking about 3.8 million for existing home sales. We saw over 5 million in 2022. So Goldman Sachs is projecting that just over 500,000 for new home sales, 3.8 million for existing home sales. That would put us, according to Goldman Sachs, at just over 4 million home sales. Obviously, our lowest number in well over 10 years for total home sales, single-family homes in the U.S. Goldman Case-Shiller prices that we just mentioned, negative 7.5, negative 2.2, and plus 3.8 in 2025. Housing starts. There's a lot of markets that we need more inventory. So the housing starts, they do believe we'll have 1.5 million housing starts this year, next year, as well as 2025. Kind of weird. That number is exactly the same, 1.57, 1.57, 1.57. So at least we're going to see consistency in building, according to Goldman Sachs. They've got some inflation measurements, labor market, and others here if you're interested in that chart. If you're interested in any of these charts, by the way, we're thinking about doing a hot sheet daily download. Let us know in the comments. Should we do some type of hot sheet daily download where you get all of these charts? I also saw, yesterday's hot sheet and throughout the week, people are interested in maybe doing some Q&A at the end of these. We're not going to do that today, but let us know if you're interested in maybe answering a few of the key questions in the comments. We could pop those on the screen. We're just trying to figure out the logistics around that. Happy to do that. Last point from this Goldman Sachs report that I thought was very interesting. Again, Goldman Sachs taking a very conservative or bearish approach to the real estate market. The bigger story here might be that Goldman Sachs has a real negative outlook on rates. Their 10-year outlook is at the 10-year. They think that's going to be at 4%. We're less than 4% right now, or higher for this year, for 2024 and for 2025. Okay, if that happens, if we have over 4% 10-year for the next 3 years straight, that will mean that mortgage rates are going to remain not only over 5, but probably over 6% for the next 3 years straight. Let me know how you feel about that in the comments. Do you agree or disagree with what Goldman Sachs is projecting? Goldman Sachs, obviously, they're going to take a very conservative approach. Don't blame them, dealing with a lot of money. But are they too bearish on their outlook? Flipping now to somebody who's very optimistic on the housing market, to somebody who's a very reputable source and has a long-standing, decade plus, multiple decade track record of being on the right side of his projections, or being very close to right each and every single year. Logan Matashami from Housing Wire, he put out a piece yesterday. Mortgage rates have peaked along with inflation. So this is counteractive to what Goldman Sachs projections were. Okay, so the CPI data cooled, even though shelter inflation is lagging. Today's inflation data, talking about yesterday, right, which we talked about here on the hot sheet, has shown that the peak growth of inflation is behind us. This should also mean mortgage rates hit their highs. He's saying, no, mortgage rates have hit their highs. We are now going to be trending down. Okay, this is different from what Goldman Sachs with that 10-year projection is saying. The key phrase I have stressed since I wrote about the case for mortgage rates to go lower on October 27th is thinking 12 months out. The trend is your friend, and the month-to-month data has cooled off noticeably. Okay, he shows the chart here from Fred, which shows this consumer price index. And there's going to be people that say, listen, you can't just base everything off of the CPI. Logan certainly isn't doing that. If you dig into a lot of his material, which we've talked about here, and we'll continue to update the highlights on the hot sheet every single day, he talks about the fact that purchase applications are up. If you're feeling that in your market, that purchase applications are up, it also means buyer demand is up right now as we sit here in January. If you're feeling that right now, let us know in the comments and hit the thumbs up button. So it's not just the CPI, but it's also this year over year inflation growth, which we're seeing trending down here on this chart. Interestingly, something that the Fed has been claiming they are comfortable with, an increase in job losses, has not happened. Okay, the Fed literally wants this increase in unemployment because it'll make their job easier on fighting inflation. It hasn't happened. Jobs continue to be incredibly strong. We talked about that earlier in the week. Also, the jobless report that just came out yesterday, you can see, was still solid and running at 205,000 for the headline, with a 4-week moving average of 212,500. So there are no increases of any substance on these jobless claims, meaning there are layoffs happening in tech. Yes, we've seen layoffs in mortgage. We've seen layoffs in the real estate industry. Real estate and tech, those two industries have been in a recession industry-wise for the last 6 months. So you would expect layoffs there. But for all of those headlines that have been made, there hasn't been this swath of unemployment, of layoffs, of job loss across the country in all sectors. If that happens, that changes the game. I think you'll see many, including Logan, if we see just a huge uproar in unemployment, maybe change their tune about where we're heading. We just haven't seen that yet. Also references the 10-year, which he believes has hit his peak. Mortgage rates should be getting better today. And we did see that yesterday. Mortgage rates did get better. We are getting closer to a 5 handle on mortgage rates, meaning leading with the 5 instead of the 6, and farther away from the 8 to 10% mortgage rates people were talking about late last year. If you remember that, we were talking 8 to 10%, certainly in July, as we hit 7% and we started to see inflation up over 9%. There was a lot of people talking 8 to 10% mortgage rates. We saw 10% mortgage rates. Those last 6 months of the year would have been a lot worse than they were. He's saying that he believes the 10-year and these mortgage rates have in fact peaked. Along with Logan, okay, Bank of America is in his camp, okay? Bank of America believes that rates likely have peaked in 2022. Mortgage rates spiked in 22 due to higher 10-year Treasury yield and widening spreads. Listen, that the bonds market are not in agreement overall with the Fed. Okay, so the markets and the Fed are on two different sides of things. You saw the stock market go up this week. So these markets believe that we have, like Logan, like Bank of America, and we'll get back to this Bank of America chart in just a second. The markets believe that we have seen the worst of inflation. Okay, the Fed is saying, no, we want to maybe overcompensate like we did when we overcompensated printing dollars. Maybe the Fed is just so scared they don't want to get the train off the tracks, and so they're going to continue to talk tough. But it seems like the Fed and the markets are on two different sides. Bank of America, differing from Goldman Sachs, they believe that mortgage rates likely have peaked. Okay, so the 10-year Treasury, they believe has peaked, but mortgage rates have come down 80 bips from peak October levels. Bank of America Structured Product Research expects 30-year mortgage rate. Okay, this is Bank of America now. They expect a 30-year mortgage rate to decline to roughly 5.25% in 2023. This chart's just like a week old, so currently 6.4. We're 6.1 on mortgage rates. That's huge. 5.25% from Bank of America would absolutely be enormous if that's the case. We get down to 5.25%. Listen, it took us to get into the sevens to make 5.25 feel like a really good interest rate, because not too long ago, just a year ago, we were in the threes. But 5.25% is something where people can start to say, hey, housing is now in a more affordable position for me as a home shopper, especially in those major cities we mentioned at the top of the show that Goldman Sachs is projecting is going to see over 10% decline in home values. You get a 5.25% mortgage interest rate, and you get a 10% decline in home values on top of that. You're really going to be in a much more affordable position for home buyers, for home shoppers. Now, just the interest rate, by the way, going down to where we are right now in the low sixes to the low fives, that 1% drop is equivalent to a 10 or 11% drop in home values based off of what you save on your mortgage, right? So obviously we know that as real estate professionals. In the comments, let me know, are you making sure people understand that as these rates continue to drop? Hey, you just saved 10% on the house when you were looking at 7%. Now they're at 6%. You just saved 10% on that house. The other interesting piece in Logan's article is this consumer price index components. The reason why some people that are bullish on what's happening right now keep talking about CPI in particular is because all of these numbers are coming down. And the one number that's really not this big number, this 42.4%, that's us, baby. That's housing. But we know that housing is a lagging measurement. This is anytime you're looking at this housing data as it relates to pricing, this is going to be really old data. It's 3 months old. So in 3 months, in theory, with the November and the December the housing market just went through, we should see a much lower number, which means as the rest of these indicators on CPI, Consumer Price Index, continue to get better as they have, we may see in 2-3 months housing start to catch up to those and get better. And this news could just keep getting better and better and better as it relates to inflation, despite what some of these more bearish projections like Goldman Sachs believe. Okay. Something I talked about a bunch on podcasts. I definitely talked about it on the Real Word podcast. And I said, be aware of this when it happened. Okay. If you're an entrepreneur, if you're in housing, if you're an investor, you definitely want to be aware of what the government was saying about the IRS, right? They passed a bill where back in earlier this year, they passed a bill where they were going to put billions of dollars into the IRS to hire 87,000 new IRS agents. You might be seeing in the headlines right now, the GOP House takes the first swipe at IRS money. This is coming from Wall Street Journal. Okay. So the new Republican-controlled House voted Monday to repeal tens of billions of dollars in IRS funding, advancing a bill that is unlikely to become law, but that previews coming battles with Democrats over the tax agency's expansion. Don't look at these and be like, oh, great. All right, they're not going to have these 80,000 new IRS agents. There's not a chance that this is going to pass. Okay, so let's remember, Democrats, they hold the Senate and the White House. They vowed Monday to block the legislation. So doing so would let the IRS keep the full $80 billion in Congress that the agency was awarded. Now, this is a decade-long expansion. That's something else that people miss. This $80 billion is spread out over 10 years. So maybe in 2024, if Republicans gain full control, of Senate, House, and the White House, maybe they're going to say, you know what, we are going to do away with the last 8 years. It's possible. But for the next 2 years, expect funding to go into the IRS. Wanted to bring that to your attention. A lot of entrepreneurs, right, in the comments right now, tax time, making sure that you're doing things on the up and up, I think is really important. I don't see that this bill is going to go away. And it looks like Democrats are saying that certainly is not going to be the case. Okay, let's move on to this controversy. I saw it yesterday. Eric posted it on the Broke Agent account, on the Broke Agent handle. I'm like, what is that? What is he? Is he making something up here? Is this a really interesting meme on the Broke Agent account? But no, this is actually happening. This is real life right now. This gas stove controversy. Let me know in the comments. Is anybody saying I'm concerned about buying a home with a gas stove right now? What are your clients saying? We have this article up on BAM. You can find it. It's trending on the top of BAM right now. This gas stove controversy. So when I dug into this, I was just amazed that this is actually a real thing. Richard Trumka Jr., a consumer product safety consumer, ignited a gas stove controversy by suggesting that CPSC should ban gas stoves. According to a study in the International Journal of Environmental Research and Public Health, indoor gas usage is linked with an increased risk of asthma in children. Okay, so a U.S. federal agency is considering this all-out ban on gas stoves, calling them out as a source of indoor pollution linked to the worsening or development of childhood asthma. And this is all done in an interview with Bloomberg. So this is like really happening. Okay, there's all these studies. You can dig into the article. There's a whole bunch of interesting commentary. There's some quotes here from Richard Trumka that we quoted. We are not looking to go into anyone's homes and take away items that are already there. We don't do that. If and when we get to a regulation on the topic, it's always forward-looking. It applies to new products. Consumers always have the choice of what to keep in their homes, and we want to make sure that they do that with full information. Gas stoves might be worse for our health than we originally thought. I think of a apartment in New York City that one of my good friends, when he first got his first finance job, he had this little tiny apartment, and his gas stove, you could just smell it. I'm like, dude, this thing is leaking. He used to keep the window open. He's like, I know they've come to fix it a bunch of times, but just is what it is. I'm like, I don't know. We may pass out in here and just not wake up. I'm so glad he's out of that apartment now. Not that I would stay with him these days. I'd be in a hotel, but you get the gist. I've never smelt gas stove in any other dwelling besides that apartment. I've had gas stoves in my homes. Are you hearing from consumers right now? Let me know what you're hearing in your market. You're hearing from consumers that this is a big deal. Listen, some U.S. cities have banned already natural gas hookups in all new building construction to protect residents and reduce greenhouse emissions. That would be Berkeley in 2019, San Francisco in 2020, and New York City in 2021. New York City is filled with apartments with gas stoves, but obviously they've banned it moving forward. Okay, that is your hot sheet today. Let me know if you would like, at the end of these hot sheets, for me to address some of the things that are happening in the comments. We could pop those in the stream. We're working through the logistics, but as we move forward into coming shows, we'll be back Monday, of course, at 9:30, every single Monday through Friday at 9:30. We may do that. We also added with the feedback to the ticker EXPI and REAL. We certainly didn't want to leave out EXP and REAL from the ticker. So we've got those running down below. But let me know your thoughts on the Q&A. And then today at 2 o'clock p.m., 2 p.m. Eastern, Knowledge Brokers Podcast. Make sure you go search on YouTube at Knowledge Brokers Podcast. Myself, Tom Toole. We're going to be going deep on some of the topics here that we discussed throughout the week on the hot sheet. We're going to go really into these prices. And let me know if you're watching this after the fact or if you're still on the live chat. Do you think it's likely or not likely that prices in your market go down? Put the market, likely or not likely that in 2023 prices go down. On Knowledge Brokers Podcast, we're going to go deep into that. It'll be up today, 2 p.m. Eastern, on at Knowledge Brokers Podcast on YouTube. Hope you've enjoyed the first week of the hot sheet. I've certainly enjoyed this. Love all the engagement in the comments. Please share this with somebody who could benefit. And I will see you back Monday, 9:30 a.m. Eastern, live on @NowBam for the hot sheet.